working or not. Right, assessing viability of projects. Please make sure that your mic is muted if you are not contributing. If you do have noise at the background, please just mute off your mic, okay? If you feel like you want to contribute, just mute yourself and make your contribution. So if we are looking at investment appraisal, we are assessing viability of investments. It's not every investment that is worth taking. Some investments would result in us making a loss, or some investments would expose the organization to risk. So what we want to do is to take those projects that are going to add value to our shareholders, and also to take those investments that we are very confident with. So when we are assessing these projects, end goal is to decide whether we should accept a project, or um, we should reject. All right, so the techniques are just evaluation or assessment methods. So let us quickly look into the techniques that we have. So we have five. There are five techniques that can be used to appraise or evaluate the projects, and these techniques are going to be categorized into two. Um, right, the basic method, that's the first category that we may want to talk about. So the word basic there, it means that if something is basic, we are saying they do not take into account the time value of money, and these are number one, payback periods. So one here is payback period, and two, that is accounting rate of return. So those are the basic methods. And then category number two is advanced methods. And these advanced methods are sometimes called the discounted cash flow techniques. Cash flow techniques. So those are called the advanced. So the difference between the basic methods and the advanced methods is that the basic methods do not take into account time value of money, and the advanced methods take into account time value of money. So how many methods do we have altogether? We have one. We are looking at number one, the net present value. Number two, we are going to look at the internal rate of return. That's number two. And number three, we are going to be looking at the discounted payback period. Those are the three advanced appraisal techniques that we want to be looking at. Now, since we have introduced the issue of time value of money, let us then discuss issues surrounding time value of money. So what we want to do here, let me just try and find a new sheet so that we are not really distracted by the notes that are there. So what we want to do here is to look at the financial management terminology that is used. So let us look at financial management terminology. Financial management terminology, so that we can understand um, the issues to do with the time, and the issues again to do with value of money. All right, so financial management terminology, first thing that we want to be looking at is time. So what is time under financial management? All right, time that is, we are going to have two types of our time here. The first time that we want to be talking about is year zero. So year zero, what does year zero mean? All right. So year zero, if we want to define year zero, is not a calendar year. A calendar year, but what? Right. This is not a calendar year. It represents. It represents the initial, right, day of starting the project, of starting an investment or project and investment, right? So the initial day of us starting our investment or the project that we want to undertake, it is called year zero. Hopefully, this is understandable. All right, that is year zero. Right, question? Right, that is our year zero here. Right. What do we call year zero? Year zero, year zero is termed present. All right, present day. Under financial management, the word present, that is what we refer to year zero. The present day is our year zero here. Let me try and make these notes quite visible. All right, that one. And we check this again, we put it right. I'm just trying to put some bullet points so that we can separate our points here. All right, that is year zero. So why do we want to look at year zero, and why do we need to differentiate year zero from other years? We want to differentiate because, let me just admit other guys into the section. Right. We are going to differentiate. Why? Because we should understand that cash flows in year zero, right? This is when you start your investment. So when you are initiating an investment or when you are starting an investment, you start off by injecting money into the project, be it buying a machinery, be it renting or leasing a machinery. You should make sure that you have invested. That is, so cash flows in year zero are negative. So a negative cash flow means what? You are injecting, and we call that cash outflows. So that is year zero. So whenever we are going to going forward, we'll be using year zero. So what does year zero mean? We should notice that year zero is not a calendar year. It's just that day, the initial day when you start, when you kickstart the project. So when you kickstart the project or an investment, you start off by investing. So when investing, it is indeed a negative cash flow. That is key and critical for us to understand. Now, let us look at year one going forward. That is B in terms of our timing, right? So let us look at B, year one. So we have year one going forward, year one going forward. So from year one, year two, year three, we call it what? First of all, let us understand how do we count a year. A year is after 12 months. That is key and critical. We can only say this is 1 year after 12 months. A year is counted after 12 months. That is key and critical. So year one going forward, What does year one going forward mean? From year one, going forward, we call it future. All right. What is future time? All right. That is future time. So we have two times. If we want to say it in simple language, we have two times. We have what we call the present time and the future time. So you realize that unless if you are doing a FM, but for FM, you see that from year one going forward, the cash flows are going to be positive. But for those who are doing AFM, you realize that you might have 2 or 3 consecutive years of still investing, making further investments. But for the purpose of understanding this, we should understand that future cash flows. So future cash flows are positive. So this is when you recoup or recover money from the investment. So positive cash flows are cash inflows. So whenever we want to show that this is an expenditure towards an investment, we show it by a negative sign. If it is a return or the cash inflow, we show it by a positive um, sign. So these are the two types of times that we have under investment appraisal. But key thing to understand, even though we have understood the issue of time, present, and future. So the present day is year zero, future time from year one going forward. What is it that we should understand? If a cash flow, occurs during the year, for example, we have started our project on 1 January 2026. And probably today, 17 June, on 17 June, we realize a cash inflow. We are going to assume if a cash flow occurs during the year, it is assumed to have occurred at the end of the year. We have occurred at the end of the year. So under investment appraisal, we are going to assume that all cash flows are going to be realized at the end of the year, not midway through. That is very key and critical. I'm going to pause and ask if there is anyone with a question with regards to the time which is present and the time which is future time. Any question so that we can proceed? Any question here? I hope this is understandable. If there is no question, we are now going to look at the time. We have looked at time. Let us now look at value of money. Right, value of money. So that if we take time and value of money, we can now separate basic methods and the advanced methods. Okay. Under time, under value of money, we are saying, first of all, is us understanding that investors, who is an investor? Investors, an investor is any person with money, right? Investors prefer receiving money now, So now means what? Today, right? Today means what? Year zero. Okay. We prefer receiving money now, which is today, or year zero, to receiving, we prefer that to receiving the same amount of money later in the future. So, assuming that you have an opportunity to receive 2,000, you would want to receive that money today and not postpone the opportunity of receiving money into probably 3, 4 years later. Why do we as investors want to receive money today? We want to receive money today due to the following. All right, the following. These are the reasons why people would want to receive their monies today rather than receiving the same amount of money later in the future, right? Due to the following reasons. Number one, what do you think is the first reason you would want your money today and not later on? Anyone? Let's just keep the class entertaining by participation. Anyone?
Impact of inflation.
Sorry, speak up. Thank you. Yes, I can't hear you. You said what?
Oh, I said it. The impact of inflation.
Impact of inflation. Thank you. Because this money is going to be eroded by inflation due to impact of inflation. So inflation is going to erode the purchasing power of your money is going to be reduced by inflation. Right? Another reason, another reason, another reason, there is what?
Low.
Yes, Santiago, thank you.
Okay, I wanted to say the consumption preference.
Consumption preference, thank you. Right. You would want to consume uh, your money because you are broke or you have something critical that you want to use money for. So, due to the consumption preference, you would appreciate receiving your money today rather than postponing the opportunity to some time later in the future. Another reason is lost opportunity, right? Opportunity on investment. So if I receive my money today, I can take that money and deposit into the bank and earn interest. So lost interest opportunity. So this is the lost opportunity on investment. So you could earn interest if you had received your money today and deposited into the bank. Another reason why we might not want to wait for our money to be given to us later on, we want because there is risk of not receiving, of not receiving. That is something that is very key and critical. Now, we have these 4 reasons why people would want to receive money today. So, assuming that, I'm going to assume that there is an opportunity, an example, there is an opportunity to receive 2000 $2,000 today, right? If the amount is to is delayed 5 years, right? 5 years, how much how much will it be worthy after 5 years? Right. Someone is supposed to give you 2,000 today, but the person is pleading such that you receive your money not today, but after uh, 5 years. So what is it that you are supposed to do? The person now, since the money is not received today, you are going to estimate the impact of inflation, probably 3%. I want to charge in inflation, the impact of inflation. So the person should compensate on the effect or the impact of inflation. Then number two, consumption preference, I'm going to put 2%, right? Lost opportunity on investment, probably another 3%. Risk of not receiving, I'm going to charge 2%. So if I aggregate these percentages, I'm going to get 6, 8, 10. So I'm going to get 10%. So this 10% now becomes the cost of the person getting my money. So I can say this was my capital. I could have um, I could have invested this money, but due to the fact that the opportunity to receive has been delayed to 5 years. So I want a compensation altogether of 10%. So the 10% there becomes the cost of your capital. So we now want to calculate how much is the money worth after 5 years. Today is year zero, right? Year zero, I was supposed to receive money today, which is year zero. So I do not have, year zero is called present. The value, present value today is 2000, right? So present value, so the word present means today. So today's value is 2000, but the opportunity to receive money is delayed to some time later into the future, which is year 5. So year 5 here, year 5 is called future. So I want to see what value am I going to get in the future. So I do not have my future value. So I have to calculate my future value. So if I'm to explain this, moving from today, going into the future, we have a value today. All right, we want to see how much is it worthy after 5 years. So if we are doing that process, we call it compounding. So we need to compound the person and get the value. So we want to compound here. So moving from today into the future, we are going to call it compounding. We want to see the value into the future. So when we are compounding, what is it that we want to find? It is a future value. FV is equal to the present value that we have multiplied by open bracket 1 plus R close to the power n raised to the power n. So what does that mean? FV is future value. FV future value, and then PV is the present value, and then R is cost of capital here, cost of capital, and then your N is number of years. Number of years. So after 5 years, what is it worthy? So I'm going to compound here to find the future value. So my future value is equal to present value. I have 2000 times open bracket my we have sorry here we have came up with our cost of capital to be 10%. So I'm just going to write cost of K equals 10%. So our cost of capital there is 10%. So we are going to compound at 10% as the cost of capital equals 2000 multiplied by 1 plus 10%, it becomes 1.10 to the power n, number of years 5. So this is going to be the amount I'm going to receive after 5 years. So a dollar today is worth more than a dollar received tomorrow. So if we are to wait until it's 5 years, we would want the person now to give, instead of them giving us 2,000. So 2,000 today is equal to 3,221.02 in 5 years' time. So moving forward is compounding. All right, a question, let me pause here and ask if there is any question. Any question? Is this clear, my friends? Compounding, we are good.
Yes.
Linda, you're okay.
Yes, I'm
Yes,
okay.
that's good.
All right, thank you. Now, that is compounding. I'll explain why we are introducing the concept of compounding and where is it going to fit. We are going to fit that compounding later as we are doing our investment appraisal techniques, okay? So let us look at a situation now where right, someone is supposed to give us, you are entitled, you are entitled to receive 10,000, let's say $10,000 after 6 years. All right. So after 6 years, you are supposed to receive an amount of 10,000. Assume that the amount can be received today, today instead. All right. How much is it worthy? Right, at a cost of capital, right, or assume 10% as cost of capital. Right, now, someone is supposed to receive, is supposed to give us money, and this money is supposed to be dispatched to us after 6 years. But we plead with them not to give us after 6 years, but we want it now. We don't want to wait until it's 6 years. We want our money today. So if the person is going to give you 10,000 today, what does that mean? If we go back to the reasons why we would want to receive money today, we can see that we no longer have these things. We no longer have impact of inflation. We no longer have the consumption preference. Why? Because we can consume the amount today because we are receiving today. No more lost opportunity on investment. We can still invest our money today, and the risk of not receiving is no longer there because we are receiving our money today. So what does that mean? It means that all these items that we have charged now, we need to remove those items from the money. So we are going to deduct 10%. So this is called discounting. So if we are now moving from the future into today's terms, we are discounting. Let me just try and put something clear that is visible here. All right, for that illustration. All right, I'm going to put year zero and um, year zero there, and then I put my year six. All right, wait, probably this could do. All right. All right, so I want year zero. So my year zero here, year zero. Right. What is the present value? Present value, we don't have the present value. It's not there. But what we have is year six. And year six, this is a future value. So the future value after 6 years is 10,000. So I want to see how much is 10,000 in 6 years. If I want to bring it into today's terms, how much is it worth? So this process now is called discounting. So the process of taking future value into today's value is called discounting. All right. So the moment we talk about the discounted cash flow techniques, this is what we are doing. We are taking future values and put them into today's value, and we see how much is it worth if it was today. So the process of us discounting now is we want to find the future value. Future value is what we have. We want to find the present value is equal to future value multiplied by 1 plus our error, okay, to the power minus n. So you realize that when discounting, you are raising to the power negative year. So this money is supposed to be received after 6 years, but we want to see how much is it worth into today's terms. So equals future value is 10, 1, 2, 3, 10,000 times 1 plus R, our discount rate is 10%, so 1.1 to the power minus 6. So if you want to raise to a negative number using your calculator, you punch, there is a button with a plus and a minus. That's the one that you use. But if you are using your laptop, power is shift 6. Shift 6, that's power. And then you can type manually -6. Okay, close. So if I'm not to, if I'm to receive that money today, the person can give me 5,644.74 cents. So this amount of 5,644 today is equivalent to 10,000 after 6 years, assuming the cost of capital is still 10%. Of K is 10%. So at a cost of capital of 10%, this is what it means. So I have explained compounding. I've also explained discounting. So you see that when we are doing the discounted cash flow techniques, for example, if we are to look at the net present value that we have talked about. Then number 2, we have also discussed about internal rate of return. Number 3, we have also discussed about discounted payback period. So whenever we are doing these techniques, all cash flows should be discounted, all right? Payback period. So this is where the concept of us discounting is going to come into play. With these 3 methods, we always need to take the future values into today's terms. So under those 3 methods, we are going to further our understanding in terms of discounting. But why have we done this item called compounding? So you see that whenever we appraise projects, we do not, all economies, there is no economy that has no inflation. So we are going to incorporate this concept of compounding when we are dealing with incorporation of inflation. So when we incorporate inflation of inflation, so whenever we incorporate inflation, we are going to be compounding all the cash flows. So first of all, we compound our cash flows using the inflation rates, and then finally we discount at an appropriate discount rate. Right. Assuming that issues to do with the terminology is done, may I please have a question from that end? May I please have a question? Right. Any clarity from my presentation here? So far, so good, I assume. All right. Let us now jump into the um, let us jump into the basic appraisal methods. Basic investment appraisal methods. Investment appraisal techniques. All right. So under the basic investment appraisal techniques, I think we have agreed that these methods do not take into account time value of money. So the issue of us discounting is not there. So key thing to understand or to note is that, let us just write that note again to say, do not take into account time value of money. Right, let me just copy this bullet point there. All right, and we rewrite that. All right, that's it. They do not take into account, they do not take time value of money. That is key. So they assume that $1 today is always equal to $1 tomorrow. That is the basic methods. So from the basic methods, let us quickly look at basic payback periods. Basic payback period. What is a basic payback period? Right? Payback period measures, this one measures how long does an investment, does an investment take to recover or recoup the initial invested amount, the initial invested amount. So if we are to assess project's viability, just hold on. I just need to plug in my charger here. Hold on a moment. All right, I'm back. Continuation. So if we are to assess viability of a project using payback periods, we are going to look at how long does it take for us to get back our money from the invested project. So that is point number one. And point number two, a project with shorter payback period is preferred. So if we are to if we are to assess different projects, which project are we going to accept? A project with the shortest payback period is the one that we accept, all right? I think that is clear and understandable here. All right, so next item that we want to look at is accepting if we are to assess a project using payback period. Of course, it's not every project that we should accept or reject. So for accept or reject, right? Here, let me just do this. Accept, right? If payback period is lower than required. So if we have set a required payback period and we assess the project, any project with a payback period lower than what we require, that project should be acceptable. And then what about rejecting? Reject, right? Only if payback is right above required. So we are going to set our own payback period. So if we assess projects and we see that a project has more years than what we require, we reject the project. All right, so let us look at how to calculate the payback period. Let us look at the formula. So our formula for payback period, number one, we have a situation whereby we are receiving equal amounts from an investment. So those are what we call even cash flows. If cash flows are even, if cash flows are even. So what does that mean? It means that same amount every year. We receive same amount every year from year one up to the end of the project. The amount that we are receiving is the same. How are we going to calculate the payback period? So formula is equal to initial invested amounts, and then you divide by the annual cash flow. All right, that is the formula there. Let me put a division sign here. All right, so that is what you are going to do. Right, example, let us just have a quick example. E.g., this is quite easy, straightforward. Initial investment, initial investment amount is 5,000. Then cash flows. Let me just accept someone into the meeting. Right. Cash flows from year one to year five are projected to be 1,500 a year. Right. So that is the example. What is the payback period? What is the payback period? So payback period is going to be easy to calculate. Our payback period, if we want to calculate it here, we are going to say, okay, how much is the initial amount? 5,000, 1, 2, 3, divided by per year. Our cash flows are equal every year. How much are we receiving? 1,500. So that is 3.33 years. That is the payback period. All right, 3.33 years. All right, 3.33 years. So our Our money is going to be recovered in 3.33 years. That is to say, if cash flows are even. In most cases, a realistic situation is whereby cash flows are uneven. If cash flows are uneven, all right. If cash flows are uneven, just make use of use a tabular approach to find your payback period. Right, use a tabular approach. Let me just find figures that can be used here. I just want to copy figures from my previous presentation. I still have those figures. All right. No ways, no ways. All right, that is okay. I'm just going to give you the figures that I have. Right. Example. Let's have this example here. A project requires an initial amount of $100,000, right? Projected cash inflows from year 1 to year 5 are as follows. All right. Um, year, right? We have year 1, 2, 3, 4, 5. So these are the years that we have. Right, cash flow, the cash inflow or cash flow that we are going to have in year 1, 50,000. In year 2, let's have 35,000. In year 3, let's have 28,000. In year 4, 25,000. In year 5, 20,000. So these are the cash inflows from our projects. And what is the payback period? Calculate payback period. Payback period. Okay. Right, calculate the payback period. So if this is the case, what we need to do now is to make use of a table to find the payback. So let's look at our solution. Right, yeah. Since we start off by investing year 0, 1, 2, 3, 4, and 5. Let's have our year, create a nice table here. All right, we put our cash flow. Our cash flows minus 100, 1, 2, 3. Why is it that the figure in year 0 is negative? It is negative because that is an investment. An investment in year 0 is a cash outflow. So let's have the figures there. Let me just use transpose. Transpose. All right, I want to take these figures here. All right, so right, we have these figures as our cash flows. So what we want is the cash that is back. All right, payback, payback amount, then payback years, payback year. Right, that's it. So in year 0, nothing has been recovered. So we still have 100,000 to recover today. That's year 0. If we go to year 1, we are going to add what we have in year 0 plus what we are ending in year one, so that we see the remainder. Year one is gone, but we haven't recovered our money. We still have a gap of 50,000. We got year two, we have this balance plus what we got to reduce the balance to how much? To 15,000. Year two is gone. Still, we have a gap of 15,000 in order for us to recover our money. All right. Again, let's move to year three. If we go to year three, we can see that in year three, we are going to receive 28,000, but we don't need 28,000. We only need, um, we only need 15,000. So we want only 15,000 in order for us to recover. I'm going to type what we want. Why? Because we are going to realize more than what we require. So we are not going to wait until it's year end in order for us to recover the 15,000. We want to see how much, what proportion is 15,000 into 28. So equals 15,000 divided by 28,000, all right, times 12 months. I want to see how many months are there. So we have 2 complete years and 6.43 months. That's what we have. So my payback is 2 years, 2 years, and 6.4 months. So my money is going to come back in 2 years and 6.4 months. This is how we calculate the basic payback period. May I please have a question? May I please have a question? Right. Um, all right. Tatenda, you are now in the meeting, right?
Yes, I am. Yes, I am.
Admitted. All right. I'm just seeing your message just now. Okay. Right. Done. That is the basic payback period. So let us look at advantages. What do you think are the advantages of using payback period? Uh, of payback period. What are the advantages? Let's look at advantages of payback period. One, yes, and one advantage. Want to track advantage of payback periods.
It is easy to understand and calculate.
Thank you. It is easy to calculate. It is easy calculate and understand. Right? Understand. All right, that is key. This is easy to calculate and understand. Even if you want to explain to non-financial managers, they can easily understand the payback period. Another advantage of payback period is that considers cash flows only. Considers cash flows only, right? Unlike ARR, we are going to look at ARR. ARR, when appraising viability of a project, they do not, it doesn't make use of cash flows, it uses profits. So that is an advantage of us using payback period here. Another advantage is what? Right? Can be used to mitigate risk. How? By accepting projects with lower payback. So why are we saying payback can be used to mitigate risk? We are saying a risk of a project will increase with life. So if your project is diving deep into the future, many years, it means that there is risk there. All right. So if we accept projects with lower payback period, we are going to avoid or mitigate that risk. Okay. Another advantage is that payback period is built as a first screening phase, can be used as a first screening phase for further appraisal. Appraisal by other methods, by advanced methods. So that is the advantage of us making use of the payback period. Right. Question. I hope this is clear and straightforward. We want to move very quickly. Right. Disadvantages of payback. Disadvantages. I want you guys to participate. This is quite easy, straightforward, and I hope to everyone or to majority of us, this is a revision. Let us be honest. This is a revision. Right. Right. Disadvantages. What do you think are the disadvantages of using payback period? Number one, the easiest one. Yes, from two. Are you still there? All right. Tatenda, I'm seeing your hand is up. I may not be able to see. You just unmute yourself and shoot. Okay.
Okay. The payback period is not. It's not realistic.
What?
We have to. It's not realistic.
Payback period is not realistic. Okay. So you guys, there's no need for you to raise up your hands. Okay. Just unmute yourself and shoot. Yes, Melinda. Right. Let's write your point, my friend. There is no standard payback period. Okay. Any project will therefore is therefore acceptable by different organizations. So in order for you to accept a project, you set your own payback period. So company A says 5 years, company B says 3 years, company C says 7 years. You see that any project becomes acceptable to different organizations because we do not have a standard to say if it's above 5 years, it's a risk to every company, it's a risk to everyone across the globe. We do not have that. So that is the disadvantage. Yes, my friend Melinda.
It ignores the time value of money.
Thank you. It ignores the concept of time value of money. Thank you. It assumes that $1 today is $1 tomorrow, right? Ignores the concept of time value of money. That is key and critical. That is a major disadvantage of us using payback period. So you realize that another disadvantage of us using payback period. Come here, and you see that after our money is back, we haven't considered cash flows after the payback period. So that is another disadvantage to say ignores cash flows after payback period, right? Ignores cash flows after payback period. So we don't consider them. That is a disadvantage again. Another disadvantage is that, right? Any other disadvantage? Probably I may write down the disadvantage that you want to talk about. Anyone? 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 No one. All right. So payback period again, right? ignores timing of cash flows. What does that mean? Timing of cash flows. Let me explain this. If we are to access projects with different lifespans, different cash flows, and etc., we might be tempted to accept, or rather, we are tempted to accept projects that have high returns in initial years, and probably we have losses later during the lifespan of the project. And we are going to ignore or reject projects that start off by giving losses, but later on we have huge profits. Okay, so you are going to see that, for example, I give this example to other students to say, if, for example, if you have probably a project of construction, you have a project of probably ordering let's say laptops from China, and you have poultry project, you are going to make use of payback period, and these are mutually exclusive projects. You are supposed to accept one project. So if it is construction, in 6 months' time, you are still investing money into your construction. You haven't aunakana any cent rawana back. If you are importing, assuming you're importing from China, the laptops, 6 months, all right, 6 weeks rather, 6 weeks, your goods are still in transit. You haven't sold anything. But if we do poultry, broilers, in 6 weeks' time, we are making a sale. What does that mean? It means that we are then lured to accept the poultry project. But does that mean at the end of each project, the poultry project is the most profitable project? No, we haven't looked at the timing of cash flows. Some projects pay, but they pay later. Some projects pay, but they start off by making some losses in initial years. That is timing of cash flows. Right. Next item is that profitability of a project is not highlighted. Profitability of a project is not highlighted. So if we are to take a project just because it's paying back our money early, that is not the mindset of an investor. Every investor would want to see or to assess the profits at the end of the project life. So with payback now, that is not going to be highlighted. That is not going to be included in our assessment. Right. Here comes the end of our payback period. The basic, the first appraisal technique is done. Right. Questions before we move on to the next? Any question before we look at accounting rate of return? Rate of return. Accounting rate of return. Right, question, my friends. Any contribution? Right. Right. Question. Before we look into, yes, Esther, any question? Esther.
Jose, I don't have any questions there.
Yes,
Let's move on.
Natalie. No question.
Yeah.
All right, thank you. Okay, let us look at accounting rate of return. We are saying measures the project's profitability over its entire lifespan. Okay, lifespan. So the project's profitability over entire lifespan, that's accounting rate of return. ARR ARR make use of profit before interest and tax to assess viability of a project. Right. We are going to make use of profits rather than cash flows. You make use of the profits. That is a ARR for accepts. Right. If a ARR is above required, right? Reject. If ARR is below required, so we are going to set our required return for each project. If it exceeds the minimum returns, we are going to accept. If it doesn't, then we reject the project. Okay, so formula B is our formula for ARR. All right, we are going to have average profits, right? Average profits divided by average investment, right? Times 100%. I'm going to type that one manually. Divided by close here times 100%. That is our ARR. So if we are assessing using ARR, average profits divided by the average investment times 100%, right? What is average profits, right? Average, for you to get average profits, you are going to do this. Average profits is equal to total profits for OS, yes, divided by number of years. Okay, that is average profits. This is how you find your average profit. Average investment is equal to initial investment plus scrap. Okay, initial investment plus scrap, then divided by 2. Right, divided by 2. Scrap is the value, is the trade-in value at the end of the projects. After you are done with your project and your asset still has a value, you can sell the asset and get something. So that is a ARR. Let's look at an example. Example here. I'm going to just take the figures that we had on our payback period. We make use of those. All right. Right. Projected cash inflows are this. I'm just going to copy and crack it a bit in order for it to suit our requirements here, right? So a project requires an initial investment of 100,000, okay, and 100,000, and has a scrap value, right? Let me do this and insert, right? Yeah, and has a scrap value of 5,000 after 5 years, right? The projected cash inflows year 1 to year 5 are as follows, right? Assume the required return is 22%. Recommends whether accept or reject. Right, we have a project, and this project is going to run for 5 years, and these are the cash inflows. Our initial investment is that one. Right, so the organization would require a project with minimum returns of 22%. So are we going to accept this project, or we are going to reject? What is key, first of all, is to find, number one, let's have solution. Solution. Um, First of all, we want average working one. Let me put a working here. Average profits. Average profits. Right. From the 5 years of the project, how much are the profits? I'm going to have total cash flow. Total cash flow minus depreciation, less depreciation. I'm going to put total depreciation, and this is going to give me total profits. So my profits after 5 years. So total cash flow from year 1 to year 5. I'm going to add all my cash flows. These are the cash inflows. Right. Those are the cash inflows. Total depreciation. How am I going to calculate my depreciation? Depreciation, we are going to calculate depreciation using this simple method. We have started our project with value of 100,000, but at the end, the value is 5,000. What does that mean? It means that 95,000 was depreciated. So our depreciation is 95,000. Yeah. Okay. That is the depreciation. And then my total profits, I'm going to add the two. Total profits for 5 years, I'm going to have 63,000. But the 63,000 are for 5 years. Average profit is 63,000 divided by 5 years. That is my average profit here. Hope it's followable, and I hope I'm not traveling with a speed. All right? Question on average profit. Okay, is this followable, guys?
Yes, sir.
Okay. Now my average investment, investment, I'm going to have equals, open bracket, initial 100,000, 1, 2, 3, plus the scrap 5,000, 1, 2, 3, close, divided by 2. So my average investment is 52,500. And then my ARR here, counting rate of return, is equal to, open bracket, this divided by that, close, times 100%. Right, so I'm going to have 24%. That is 24% direct. So can someone recommend, should we accept this investment or we reject? Assuming management requires a return of 22% and we have assessed and got 24%, should we accept the project or we reject? Anyone? Any contribution?
We should accept because it's above required
Thank you,
rate.
Esther. Thank you, Esther. We are going to um, we are going to accept Why? Because ARR is above what is required. Okay. Sorry, a moment. All right, that's it. So this is ARR. So quickly, let us look at advantages and disadvantages. Then we move to the net present value. Advantages, right? Advantages of ARR. Let's look at them very quickly. This is quite easy, straightforward. The basic methods, yes, of course, we do them, but they are quite easy, straightforward. All right. Advantages of us considering ARR. Number one, unlike payback periods, unlike payback periods, right? ARR covers whole life of the project, of the investment. So if we are to assess using ARR, we are going to see that we consider all items when it comes to life of the project. Another advantage is that it is easy to explain to non-financial managers. It's easy to explain to non-financial managers. That is another advantage. Okay, profitability of the project is highlighted. Of a project is highlighted. So you can actually see that this project has got a percentage return of 24%. So that is profitability of our project, and that is highlighted. Okay, can be used, right? ARR is a relative measure. So anything that measures in terms of percentages, we call it relative. ARR is a relative measure. Relative measure, A can be used to compare investments with different capital size. A capital size. So if we have two projects and these are mutually exclusive projects, we can't undertake them together. We have to choose one and leave one. It means that if we use ARR, we just compare and take the one with the highest ARR. Those are the advantages. Disadvantages of using ARR. What are the disadvantages? Right, disadvantages. Number one, right, N1. Right.
It ignores the concept of time value of money.
Sorry?
It ignores the concept of time value of money.
Ignores the concept of time value of money. Thank you. Ignores time value of money. All right. All right. Ignores time value of money. Another item, another disadvantage. Right. Number two is to say that incorporates non-cash flow items, incorporates non-cash flow items, e.g. depreciation. So depreciation is not relevant, it's not a cash item, and this one it incorporates, all right, typo error there. It incorporates the non-cash flow items like depreciation. Any other disadvantage, size of the project is not highlighted here, Right. We are not going to highlight size of the project. Okay. Let me put there size of a project is not highlighted. Okay. That's it. That's another disadvantage of us using ARR. Now the basic methods are done. Any question with regards to the basic? We want now to look into the advanced um, methods to investment appraisal. Person, please, person.
Nice.
Yes.
Hello.
Yes, Natalie, go ahead.
From a disadvantage, I conflict with the shareholders' view of
Yes,
wealth
it conflicts with the shareholders' view of wealth maximization in a case of mutually exclusive projects. Why? Because we choose a project with highest percentage, and highest percentage doesn't mean highest value. So ARR conflicts with the shareholders' view of wealth maximization. That is a good contribution. That is very correct. That is very correct. All right. Any addition, my friends? Additions?
It uses profit before interest and tax, which is no longer relevant to the valuation of
Yes.
the project.
Yes. Right. It's not relevant because it ignores that an organization should also pay the interest, should pay the taxes. From the amount that we get, we should pay interest, we should pay tax. That is a good observation, and that is correct. Well, you guys are interesting. You are interesting. Any other contribution? Yes, Rose, my friend.
I'm there, sir.
And you are there.
Ndiriko.
All right. From a final order All right. Let us look at net present value. These are discounted advanced appraisal techniques. Right? The advanced appraisal techniques that we want to look at. Number one, we would want to consider the net present value. Well, before we proceed, I want to tell you that net present value is very key and critical, right, for your studies, both FM and um, AFM. Right, let us look at net present value. Net present value. Net present value. Net present value. Right, when we look at net present value, we are now going to look at the issue of us compounding and discounting and assess whether a project is viable or not. Right. Net present value, sorry about that. Right. What is net present value? Right. Accesses the NPV, accesses viability of viability of an investment by adding two things. By adding two things, what are they that we add? Right, we are going to add two things. Number one, we are going to add the present value of investment in year zero. Right, you add present value of investing right, of investments, which is negative, and this is in year zero. You are going to add it to year zero, and else the present value of future cash flows discounted at the company's cost of capital, cost of capital, right? So what is it that we do? We are going to add two things. Number one, the present value of our investment, which is year zero, plus everything that is in the future. But whatever the value that is in the future, we need to discount and bring it into today's value or today's terms. So that is what we do when we are assessing viability of projects using the net present value. So for accept or reject, accept accept if NPV is positive, right? Reject if NPV is negative. That is key and critical when we look at NPV. So negative, we reject; positive, we accept. Let us look at an example. An example is this. Let me just copy. I'm just going to use these figures more and more up until um, we understand these things better, and then we bring in a question that we should then be able to compute. So I'm going to put my values here. Oh, that was that was okay. This is not a good way of copying. Let me just copy the whole item here and press back. I'm just going to tweak the question a bit to suit our needs here. Right. A project, a project requires an initial amount of 100,000, and then let me just remove the script there. Right. I'm going to remove script value. I want to remove it for now. Right. I just want projected cash inflows, projected cash inflows of these ones are available from year 1 to year 5. Right. Calculate NPV and advise whether the project is viable or not. Right? Assume 10% cost of capital. Cost of capital. All right. Assume 10% cost of capital. Now, when we are to assess a project using net present value, this is what we are going to do. This is what we are going to do. All right. So first of all, let us have our years. So under financial management, and even those who are doing AFM, we don't do numeric text. We have text separately and the numeral figures separately. For example, I know that my investment will start from year 0, 1, 2, 3, 4, 5. Right. I have my 5 years. I'm going to make it a bit smaller here. Right, 5 years of my project, I have laid down my 5 years here, and I put my cash flows, all right, minus 100,000, 1, 2, 3. My initial investment is 100,000. I'm going to put it in year 0 like that. And then from year 1 to year 5, I have these cash flows, right? Year 1 up to year 5. These are the cash flows, right? Is my speed still okay, my friends? You may need to do this on your laptop, please. Okay. Because we want to learn how to do NPV. We are going to take, we are going to calculate our NPV in 2 ways. And then the third way, I tell you what to do. But for the meantime, let us copy down all these items in our Excel, right? I want you to make use of your Excel, right? Can you please copy down these values so that we can calculate NPV together? Please do that very quickly. Please do that very quickly. Please do that very quickly. Are you done? Is there anyone who is copying down? Anyone? We might wait for no one.
Yes, I'm putting down.
Yes, until
Yes, I'm copying down. And number first, I need to challenge. So I'm copying down, but I'm catching up.
right, those who are copying down, please do that very quickly. Tell me once you are done so that we can continue. Done? Done or not done? Done or not done? All right. Let's then compute our NPV. So the net present value, you see that whenever you are discounting, a cash flow in year 0 can never be discounted. You can't discount whatever that you have in year 0. But this is already in the present value terms. But if you can check from here, from year 1 to year 5, this is where the future is. So the future cash flows needs to be discounted. Right, I'm explaining that. So how do you discount? We have agreed that in order for us to discount, we say the future value times 1 plus r to the power minus n. This is how we are going to discount the cash flows. So what we want to do, we want to create our discount factors separately. 1 plus r to the power n, that's what is missing there. The future value is already there. Our future values are the cash flows. So at the end of the day, we want to multiply the future value and that discount factor 1 plus r to the power n. That is our discount factor. So let us do that, okay? Let me just remove this. Right, so discount factor, right, discount factor, I'm going to have my discount factor is equal to open bracket 1 plus r. Our discount rate is 10%, it's 1.1. Shift 6 is to the power, shift 6 minus 0. I click on year zero there, as you can see, if it's visible, right? If you click on year zero, press enter, you'll see that the discount factor for year zero is always 1. If you use the discount or the present value table, you will realize that there is no discount factor for year zero. The assumption is that you can't discount something that you already have. That's why the discount factor is 1 there. So if you go there, don't type manually 0. You have to click where the 0 is. Then you drag up to year 5. When you drag up to year 5, you can see the discount factors. Are my discount factors visible at your end? Can you see them?
Yes.
Yes. So I have done this column of discount factor. That's 1 plus r to the power minus n. So the present value, I now have 2 types of present value. I have a present value of year 0, which is negative. So I'm going to have 100,000 times 1. Already this one is negative, and then I multiply everything, but the easiest thing is to just go there, you drag up to year 5, right? You now have your present value, and the present value of your cash flows are these ones. Now let me just highlight them so that you can see, right? These are my present values. So we say that net present value assesses viability of projects by adding 2 things. Number 1, the present value of the investment, which is year 0, and it's negative, and the future values from year 1 to year 5 discounted at the company's cost of capital. In this case, it is 10%. We've discounted them. So in order for us to get net, the word net present value comes from the fact that you have positive and negative. When you combine the 2, you should get a net. But your net should be positive in order for you to accept. I'm going to add all my present values from year 0 up to year 5. This is what I get. I'm getting a net of 24,910. If there is someone to advise, should we accept or reject the project?
I think we should accept the project because the net present value is positive.
Thank you, Rose. Yes, we should accept the project because net present value is positive. So what does that mean? In this case, we are saying we have invested 100,000, but this 100,000 was provided to us by someone, and the person had charged us 10% as their cost of capital. So the moment we are discounting, we are giving back the investor their money. All right. So what is it that we have? It means that after giving back the investors their money, we are going to be remained with the 24,910 and 74 cents. That money is now accrued to the shareholders. Our shareholders are going to benefit that 24,000 there. That's what it means. This is the first way of you calculating your net present value. But you can only do this if you are lazy. If you are not lazy, I'm going to copy this and paste there. I want my net present value. What is it? I just want. All right. I just want my cash flows. The cash flows I want. Okay. I just want to put my cash flows and I go direct to the net present value. All right. Discount rates. Another method, I put my 10% there. That's my discount rate. I want to calculate NPV in a quicker way that is simple and straightforward. And then from there, I go direct to net present value, right? NPV. So my net present value, I'm going to say, okay, fine. I know that anything that is in year zero cannot be discounted. Everything that is in year zero cannot be discounted. So first of all, I'm going to have my year zero value here, right? I'm going to click at 100,000. I'm clicking at 100,000 because I don't want to discount that. Even if I discount, the discount factor is 1. I'm going to get back my 100,000 as it is, then plus type manually NPV. Type manually NPV. When you type manually NPV, open your brackets. You open the bracket like this. You click the rate. All right. If you haven't written down the rate, you can actually type it in 10% and then comma. Click the rate 10% comma and then highlight your cash flows from here 1, 2, 3, 4, 5. You highlight those cash flows, close brackets, enter. You should get the same net present value. So this is the quicker and easy way of calculating NPV. It saves much of your time. But well, the examiner accepts both the ways. We do have students who are lazy to calculate the discount factors there. You can actually copy them from the present value table. If you don't know how to do that, you can reach out to me. I show you how you can make use of the present value table to get these discounting factors from year 1. You will not get a discount factor for year 0. Why? Because year 0, the discount factor is assumed to be 1. All right. Question. What is the question that you have in terms of the net present value? We want to push the net present value up until we are able to answer section C questions, or any question for net present value. You should be able to answer the questions. Okay? Right? Any questions?
Hello, C.
Yes, go
Hello,
ahead.
C.
Go ahead.
Sorry to take you back.
No.
Ndachida kubvunza pa method yamatanga kushandisa pakutanga apo pamadiscounting factor handina kunyatsonzwisisa payear 0 apo kuti maita sei.
Which one?
Mati 1 plus discounting
one?
factor yepamethod yekutanga. Yes.
Okay, this is the formula. You are going to say equals year 0 value, the value of year 0, which is 100,000, plus, then you type NPV. Open bracket.
The second one I understood, but the first one I didn't
The first
get
one,
it.
this one here.
Yes, the first method. Yes.
Right, ukati wewe 1.1 to the power minus 0, it goes back to 1. So if you are going to year 1, the reason is I don't want you to type manually 0 like this. Can you see? If you type manually 0, when you drag year 1, you need to put 1. In year 2, you need to put year 2.
Okay.
But instead, I can just do 1.1 to the power minus.
Okay.
I just click where 0 is because my years are laid 0, 1, 2, 3, 4, 5. When you drag, for example, if you come to year 1, you can see that it's picking 1 automatically. Year 2 is picking 2 automatically. Year 3 is picking 3 automatically. That is the trick. Understood?
Okay, thank you so much.
All right. Now, I want us then to look into the net present value format. So what does that mean? It means that whenever we are assessing a project, we are going to incorporate a lot of things. So what we need to do now, we need to look at NPV format. NPV format. And then from this format, we are going to pick a few things that we need to work on so that any question with NPV, we are able to answer. So NPV format, I'm going to have an example of a project probably with 4 years. So NPV format, when assessing a project using the net present value, because net present value is the most critical investment appraisal technique that we guys are supposed to be knowing at this level, and even at AFM, it's still being examined. So you should be able to know the format and incorporate a number of items that I'm going to highlight here. So NPV format, we have to have our year 0, 1, 2, 3, 4. I'm just going to limit my project to 4 years. So these are the years, right? So I'm going to divide my, I'm going to divide my NPV format. This format, I'm going to divide it into 2 sections or 2 segments, all right? So the first segment that I want on top here is the operating side or the revenue side. When I go to the downside, I want my investment side. So in year 0, 1, 2, 3, 4, first of all, when we are operating, we anticipate to have sales. So your sales are going to start from year 1, which is positive, right? Positive cash, right? From year 1, positive cash, positive cash, positive cash, right? Those are the
Hello,
sales.
say.
Yes, madam.
Hello, say.
Yes. Yes, I can hear you, please.
Hello, this screen is not sharing. I don't know if my side why. The screen is not sharing.
The what?
The screen is not sharing. Maybe this side, I don't know. I'm not seeing the screen. The
You're
screen, the
not seeing
screen.
the screen.
I can't see.
Guys, is my screen visible?
Yes, it is.
Yes, it
Yes,
is.
it is.
What you can do
Yes,
is to,
right.
Esther, just exit and rejoin. We'll just give you 30 seconds to do that. Exit and rejoin.
So it means my side. Okay. Okay, thank you.
All right. So our sales are positive cash, positive cash, positive cash. Because when we sell, we anticipate to have a cash inflow. Variable costs, our variable costs, right? Variable costs. So our variable costs are going to be negative. I have to put this. It's one negative cash, right? Negative cash, negative cash, negative cash, right? Our variable costs are negative because it is an expense, all right? Negative, negative. Relevant fixed costs, we'll talk about relevant costs. Relevant fixed costs, also negative, 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 right? Negative costs, right? If we are going to talk about relevant again, all right, confirm that my screen is still visible, my friends.
Yes, it is.
All right, thank you. There was a disturbance from this side. All right. Negative cash, negative cash. Then we have operating cash flow. Operating cash flow. So your operating cash flow, you are going to add from sales to your opportunity cost if there is any opportunity cost. All right. It's not always the case that we have it. We anticipate that most of our questions we have that. Okay. So we are going to have our positive cash. We anticipate positive, positive, positive. All right. Once you have done this, right, these cash flows, the operating cash flow, they are supposed to be taxed. So you are going to have taxation. Our taxation is going to be negative, right? You pay tax on these cash flows, negative, right? Negative cash, negative cash, negative cash, negative cash. All right. Once you have done this, it means that your operating side or your revenue side is done. So this top part that we have done here is the operating or the revenue side from there to there. So I can call it REVEX. Okay, this is the revenue expenditure that we have. After we have taxed our cash flows, we shall be talking about that taxation in detail. After we have done that, I am going to have another down item, which is the capital side. So I can try and make it a bit different. Right, this is too bad, but well, it's okay. Right, so I'm going to have my capital side. So capital side, I'm going to have initial investment, initial and scrap. So initial and scrap, my initial is a negative cash in year 0, negative cash there, and then scrap is going to the final year as a positive, right? Positive cash, right? So I put my initial investment as negative, and the scrap, if it is available, it is going to the final year. And then after we have done this, I should have what we call the capital allowance or tax allowable depreciation. Tax allowable depreciation. This is a benefit that you claim. Basically, it is claimed based on the initial amount that you have invested into the business, and this is going to be positive cash, positive cash. All right, positive cash. All right, positive, positive, positive. Okay, tax allowable depreciation. You should also be able to incorporate working capital, right? This is working capital movements, right? There is no investment that you can actually have without you investing working capital, all right? So your working capital are initially negative. You are going to inject as a negative cash in year 0, and whatever that you have invested should be recovered or recouped in the final year as a positive cash in final year. But in between, it all depends with the computations that you have made. Sometimes you can see positive, sometimes it could be negative. There is no trend in between. It all depends with the computations that we have done. So negative, I can just put, so in between, from year 1 to year 3, it's not definite. I'm just giving there, I'm just giving values there so that I can just leave it blank. And then after we have incorporated tax allowable, depreciation, working capital movement, then I need to add everything. This is my capital side. When I add, I get net cash flow. So my net cash flow now from um, my net cash flow, I'm going to add from operating cash flow, right? From operating cash flow to this net. So I'm going to add there, I get my negative here, negative cash, right? I anticipate to have positive cash, right? Positive cash, right? Positive cash, positive cash, positive cash. So if you take this one, this is from this black and white um, item here, this is where we started off. So when we had our cash flows, this is the assumption that we were using, net cash flows, okay? I put my discount factor percentage there, all right? That's going to put my percentage. I want NPV direct, right? So my NPV is going to be X there, accept or reject. That is the NPV format that we want to work with going forward. Now, the yellow side here is the capital side. So you see that our cash flow statement has been divided into two. There is no need for you to divide, but you just need to know. Why do you need to know? Our tax is negative on operating cash flows, and we should have a positive tax on the initial amount, and this is going to be something like a benefit to us that we claim. All right. So from this NPV cash flow format that I have listed, that I have demonstrated here, I'm going to list a number of items that we are going to extract from this, and we want to work on them one by one up until we are done. And then we should be able now to compute NPV in full. Number one, we want to incorporation of inflation, right? Effects of inflation on NPV. Those guys who are doing AFM, please take note. This is quite important again, right? Effects of inflation on NPV cash flow statements, right? We need to look at inflation. After we are done with inflation, we need to look at effects of taxation, right, on NPV cash flow statements, right? We need to do that. Number three, we need to also look at relevant cash flows, right? Relevant cash flows is not everything that is supposed to be included, and it's not everything that is supposed to be excluded. And then finally, number four, incorporating working capital. Working capital movements on net present value. So these are the items. This is what we then need to do. If we're able to cover those things, and any question that comes in terms of NPV cash flow, we should be able to compute NPV and advise management on whether they should accept or reject some of the projects. All right. May I please have questions for today? I think I should end here. Our next meeting is on Friday. Next week, forgive me about that. Next week, we should be able to revert back to our normal timetable. Right. effects after we have done this. I'm hoping that we will be done on Friday. We look at internal rate of return, and then in terms of investment appraisal, the techniques themselves will be done, and then for you guys, for FM, we'll continue with investing decisions, and then with other guys, we'll look into what suits them best for their exam. Right. Question, first. Any question before I leave? Before I say goodbye?
Hello, sir.
Yes.
Hello, sir. Okay, mine is not a question per se, but I don't go on the journal late. And I don't go. Do we have access to the file? For example,
Yes,
this file.
everything will be available. I'll try and make it available tonight. I had a challenge.
Okay.
With my account.
Okay, thank you.
It's rectified. You should be able to receive it early in the morning.
Okay, that would be appreciated. Thank you.
All right, guys. My questions. Any questions?